We all know Apple for its great products, the iPhone, the iPad, the MacBook. I use many of them myself. Even this video is made using Apple's hardware and software. But here is a question. When was the last time Apple released something that truly changed how we live? Not a slightly better iPhone. Not something that's 3% faster or 5% lighter. I mean something transformative. The kind of things that make you say, wow, the way the iPhone did in 2007. These days, Apple is often described as a phone company, not a tech visionary. And I think today that sentiment is more accurate than ever. But what if I told you I found the exact moment, the year, even the day when Apple changed direction? Let's dive in. It was early 2013. Apple had just announced that it had over 120 billion in cash. It was still the biggest company in the world. Steve Jobs had gone for 19 months. The path seemed obvious. Keep building great products. But that's not what happened. On April 30, under CEO Tim Cook, Apple issued 17 billion in corporate bonds, the largest bond sale in history at the time, not to build factories, not to fund research, but to pay dividends and buy back its own stock. This moment marked a profound shift. Apple was no longer just a company that made extraordinary technology. It was now embracing financial engineering, prioritizing short-term shareholder satisfaction over long-term innovation. Wait, why borrow money if you already have billions? Good question. Let's quickly break this down. A corporate bond is essentially an IOU. A company borrows money from investors and promises to pay it back with interest. Companies usually do this when they need funding, but Apple didn't need the money, it had a mountain of cash. So why issue debt? Taxes. Most of Apple's cash was overseas. Bringing it back to the US would have triggered a massive tax bill, about 9 billion under the 35% corporate tax rate at the time. Instead, Apple borrowed money at historically low interest rates, and the interest payments were tax deductible. In short, borrowing money was cheaper than using its own. Whether that's a tax efficiency or tax avoidance is a separate ethical debate, but for Apple it made perfect business sense, at least on paper. So what changed after that? You might think, okay, so they paid shareholders, that's not a crime, and you're right, it's not. But the problem starts when you look at how Apple began to use its profit. Compare two numbers, R&D spending versus stocks buybacks and dividends. In 2013, Apple spent 4.5 billion on research and development. In 2024, that number had grown to over 31 billion. As a share of revenue, it went from around 2-3% to 6-7%. That sounds healthy, but then you see this. From 2012 to 2023, Apple spent over 670 billion buying back its own stock. That's more than the market value of most Fortune 500 companies. In some years, Apple spent twice as much on buybacks as it did on research. Since 2013, Apple has reduced its number of outstanding shares by over 40%, boosting earnings per share and usually its stock price. It's great for investors, but what does it mean for innovation? This shift didn't happen in a vacuum. It happened under a new kind of leadership. Tim Cook is not Steve Jobs. He's not a product visionary. He's a supply chain genius, a detail-oriented operator with an MBA. Before becoming CEO, he optimized Apple's global logistics, making it one of the most efficient companies on Earth. And as CEO, Cook brought the same mindset to Apple's finance. Steve Jobs famously avoided dividends and buybacks. Tim Cook reinstated dividends in 2012, then expanded buybacks massively. He even met with activist investor, aka corporate rider, Carl Icahn, who pushed hard for Apple to return more capital to shareholders. and Apple did. Cook focused on scaling what already worked: the iPhone, accessories, services. Apple launched the Apple Watch and AirPods, both extensions of the iPhone ecosystem. Revenue boomed, execution was flawless, but risk-taking slowed. Cook created more corporate Apple. He emphasized privacy, labor ethics, and philanthropy. All commendable, but he also made peace with financial tools that Jobs had avoided. The result? A company employed being counters approach rather than product-driven. Let's look at some examples of failed or abandoned products. AirPower, a wireless charger for multiple devices. Announced in 2017, cancelled in 2019. Even Apple, with all its engineering might, couldn't pull it off today's standards. Apple Intelligence, announced with much fanfare, but as of today, there is no real product, no working AI assistant, no game changer, just the vague promise that something is coming. While competitors ship AI features monthly, Apple has been unusually quiet. Again, the story is the same. They announce, they delay, and maybe, just maybe, they will cancel it. Apple Vision Pro. Launched in 2024, the Vision Pro was pitched as the future of spatial computing, but with a $3,500 price tag, limited use cases, and a very narrow target audience, well, sales were tipped, developers weren't exactly rushing to build for it, and the public mostly shrugged. It's not cancelled, but let's be honest, if this is Apple's next big thing, it's not looking very big so far. The list goes on. Don't get me wrong, Apple still builds excellent devices, but the company that once risked everything to launch the iPhone now seems more focused on managing what it has, not imagining what's next. Now look, we don't know for sure whether more spending on R&D would have brought us another iPhone-like breakthrough. Innovation doesn't scale linearly, but here is a thought. If you spend $670 billion, the amount Apple used on stock buybacks, on battery technology, I am pretty sure you could get an iPhone that lasts more than a day of moderate use, maybe even a week, or hey, maybe one of those new batteries they say can last 100 years? Who knows? But that's the thing. We don't know because the money didn't go there. Apple's $17 billion bond sale in 2013 wasn't just about taxes. It was a symbolic moment. The company turned from being product-led to being finance-led, from bold bets to cautious optimizations. R&D hasn't disappeared, in fact it's grown, but shareholder returns have grown far faster, and the risk appetite? That's another story. Under Tim Cook, Apple became a master of operations, a master of profitability, and arguably a master of financialization. But can it still be a master of innovation? That's the question. And one final thought. This isn't just about Apple. This is a wider shift in business, where companies across the board are prioritizing short-term returns, where financial tools often matter more than breakthrough ideas, where the goal is to manage risk, not to invent the future. Maybe it's time to ask what kind of future we're actually building, and who we're building it for. And remember, curiosity killed the cat, but satisfaction brought it back. See you in the next one.